You're listening to the Financial Source podcast on YouTube.
It's Wednesday, February 18th, 2026. And if you've been watching the markets today, you know that the whole soft landing story just hit a brick wall.
Oh, it's brutal out there.
We're seeing a massive repricing of risk. The charts are just ugly.
Feels like everyone's trying to solve a three-variable equation where, none of the inputs make any sense.
What are the three variables?
Well, you've got U.S. macro data that's just too hot. You've got energy prices spiraling because of what's happening in the Middle East. And then there's the Fed.
The Fed.
Yeah. And honestly, they look completely paralyzed.
Paralyzed is the perfect word for it. I was just reading through the source material on the latest FOMC minutes, and usually you see them trying to build a consensus.
Right.
It was a brawl.
A three-way brawl, really. You have one faction that's basically screaming for rate cuts, thinking inflation is over.
Done. Cooked.
Then you have another group that just wants to hold steady, do nothing. But the scary part, and this is what the market is freaking out about, is that third group.
The two-sided risk crew. I saw that phrase, and I just froze.
Yeah.
That's Fed speak for, we might actually have to start hiking rates again.
It is. And to hear that now in 2026, it implies they think they've lost control. It signals that the hiking cycle might not actually be over.
Which is wild. But then you look at the data, and I sort of get their panic. The U.S. economy just refuses to cool down.
It's too resilient.
Yeah.
Which keeps yields high.
And the bond market is flashing its own warnings. Did you see the 20-year Treasury auction?
Oof. Weak. Very weak.
And for anyone who doesn't track this stuff daily, that's a big deal.
A huge deal. It shows waning demand. Investors are basically saying, if you want us to hold U.S. debt for 2 decades, you need to pay us a much, much higher premium.
And that puts a stranglehold on the economy.
Yeah.
But normally the Fed would just tighten into that kind of strength.
They would, but they can't.
Not with the geopolitical situation.
Not with what's happening in the Middle East. That is the real driver here. You can't just hike rates when you're staring down the barrel of a potential war.
Oil rallied more than 4%. Just on a rumor.
A rumor of imminent U.S. military action against Iran. That's not a supply and demand move. That's pure fear.
And that brings up the one word that every central banker on the planet dreads.
Stagflation.
It's the absolute worst-case scenario.
It really is. If this tension creates a sustained oil shock, you're importing a ton of inflation. But the uncertainty of war, it just kills growth.
So you get soaring prices and a slowing economy at the same time.
Exactly. And the Fed's normal toolkit is useless there. If they hike to fight inflation, they crush an already slowing economy.
Which has to explain what we're seeing in gold. It touched $5,000 an ounce. That number looks like a typo.
It does, doesn't it? But gold is playing this dual role. Usually high yields are bad for gold.
All right, because it pays no interest.
But the fear trade is so strong right now, investors are just ignoring the yields. They are buying gold at $5,000 to hedge against, geopolitical chaos.
It's a tug of war between the bond market and the war drums.
And we're seeing that stress everywhere. Look at the currencies. The yen is testing 155, even though their own industrial data looked pretty good.
And the British pound is near its monthly lows, below 1.35.
It's fascinating, right? The UK has slowing inflation, so the Bank of England is hinting at cuts. That weakens the pound immediately. It just shows how out of sync the US is with everyone else.
So if I'm listening to this, the whole vibe has shifted. It's not when are the cuts coming anymore. It's more like survival mode.
It's a transition period. The dominant theme now is higher for longer, but with a major caveat.
Unless something breaks.
Exactly, unless something breaks. The strong U.S. growth supports higher yields, but these geopolitical shocks threaten to break the whole system.
You definitely can't just set it and forget it when gold is at $5,000 and aircraft carriers are on the move.
No, and that kind of leads to the big final question, doesn't it? For you, the listener, in a world where a single geopolitical headline can wipe out a month of economic data, does the Fed actually have any control left?
Or are they just passengers, like the rest of us, waiting for the next breaking news alert, something to chew on? That's our deep dive. We'll see you next time.